Mike Wilson, how do you factor in, not yet, but sometime in the future we will, in an earnings situation and in terms of how you want to be investing?
Yeah, so look, I mean, I think the tariffs have all been about China and international markets taking the brunt of the pain, but we think that's going to start to now trickle over to the United States. We wrote a note last week on margins. We'll talk about that a little later, I think, in detail. But the bottom line is tariffs is part of that, right? And this tariff issue and China slowing, by the way, is also part of that. So look, next year we're not that optimistic about where expectations are. We think expectations are too high. If the expectations were to come down, we would feel a lot better about the markets in the U.S. But they're still too high.
So when you take a look at the conversation about a couple weeks ago was the U.S. exceptionalism,
right,
that outperforming the rest of the world, you expect that gap to close because the U.S. is going to come down to the rest of the world. Is that a fair assumption?
Yeah, and that's been our call for the last couple of months. It's just that this sort of divergence, whenever this happens to this extreme, it never holds, right? Decoupling, as we've said in the past, whenever people talk about decoupling, it usually recouples pretty quickly. And the real outlier, as we outlined a few months ago, was really growth stocks. Okay, so U.S. growth stocks and small caps were the real outliers within the U.S. equity market. Most of the U.S. equity market this year has kind of re-rated lower. And now I would argue the U.S. growth stocks and small caps are taking their turn. We think it's probably halfway done, maybe 3/4 of the way done. We've done a lot of damage already.